Welcome to this personal tax roundup for this month. My name's Dean Wotton. We're first of all going to look at the installation of home electric charging points. That's for electric cars. Now, it's fair to say that the purchase and lease of electric cars is increasing. There's a low benefit in kind. Most of the purchases, leases are through corporates. So there's a low benefit in kind, which has been confirmed for the next 3 years as well. And you've got the increased practicality of them, with the ranges coming out quite high. So they're becoming more popular. Now, grants of £2,500 are available on the purchase of electric cars up to £35,000. A lot of cars being bought or leased are over £35,000, so you won't get that grant, but some are under, so there are some are under £35,000. So that grant gets deducted by the manufacturer or the VW showroom, for example. Now, currently, there's also a £350 grant available on the installation of home charging points. However, owners of detached, semi-detached, terrace houses and bungalows will no longer be eligible for this home charging grant from the 31st of March 2022. The grant's focus is going to shift to densely populated areas where flats are the predominant property. The government feel there's a lack of electric cars in those areas, so that's where the grant's going to be focusing. Orders placed prior to and including the 1st of February 22 will still qualify for the £350 grant, but this is subject to payment, documents being completed and the installation done by the 31st of March 2022 for owners of detached, semi-detached terrace houses and bungalows. The Scottish EST and commercial grants will still remain in place though. So electric charging points, they currently have a grant, but that grant's not going to last too much longer if the directors of companies, for argument's sake, live in detached, semi-detached houses, etc., bungalows. We're now going to look at a case concerning the wholly, exclusively and necessarily incurred employment expense rule. Very difficult to get deductions under this one. Now, this individual, a qualified dental surgeon, lived in Southampton with his family. And he undertook a 4-year training contract in London to become a maxillofacial surgeon. And these surgeons, they're involved in conditions, defects, injuries, etc. For mouth, teeth, jaws and face. You've got to be a qualified dentist to even start this, and then you've got to have a 4-year residency in a hospital. So that hospital for this individual was in St George's in London. Now, he worked very long hours, and he needed to live within 30 minutes of the hospital when on call. And he just couldn't make it work from Southampton. So he lived in rented accommodation midweek, plus one weekend when he was on call. Now, during his 4-year contract, he incurred £39,000 of accommodation-related costs, and he claimed they were wholly, exclusively and necessarily incurred in the performance of his duties. HMRC denied the claims, and they issued careless behaviour penalties totalling £7,600. So Mr Kunjur appealed against this ruling. Now, it's worth looking at the rule for Section 336, because that's what he's trying to get the deduction under. Now, the general rule is that the employee must be obliged to incur and pay the cost as a holder of the employment, and the amount is incurred wholly, exclusively and necessarily in the performance of the duties of the employment. And that's hard to have that. It can be done, but it's really hard to get these two tests met. Now, this went up to the first tier, and the first tier made a few interesting comments. Now, his formal on-call duties required him to be able to treat the patient within 30 minutes. So, for that time, he was obligated to rent accommodation close to the hospital. But that doesn't mean you're going to get a deduction, because you've still got to meet the wholly and exclusive part of the test. Now, this means that there mustn't be any private benefit to him. Now, they agreed there's no private benefit at the weekends when he was not on formal on-call as he returned to Southampton. So he wasn't living in London whilst he was off. Now, when he was on formal on-call and actually at the hospital, there was no private benefit. When he was on informal on-call and speaking on the phone or at the hospital, because there's no private benefit there. But There was no requirement for him to undertake research and prepare articles close to the hospital. This is part of his residency that he did. But there's no requirement for him to undertake that in London. He could have done that from Southampton. So therefore he obtained a private benefit during that time. Now, as for the in the performance of test, now he did set aside the test when speaking during informal on-call phone calls from his flat, because that was in the performance of his duties. However, when he was on formal on-call at the hospital, the flat was not being used in the performance of the employment. So therefore there was no in the performance at that point. Waiting at the flat for a call was not performing the duties. So there was only a very small proportion of the expenses that were capable of satisfying the 336 requirements. That was when he was obligated, because of the 30-minute call-out rule, and he was on the phone at that time. So very, very small elements of the costs were deductible. Now, the tribunal said, well, that's what is deductible, and go away and sort it out yourselves. But the penalties should be reduced to naught. Because he's entitled to rely on his advisors. And it is quite a tricky area. So he's not going to obviously have the deduction for the majority of his costs. There'll be a little bit, but not very much at all, because these costs are really hard to get. He's going to be obligated. He's then going to incur them wholly and exclusively in the performance of his duties. Tough. So yes, he'll get a little bit, but I guess he's got the penalties waived, which is a positive. Now, the next case concerned the aggregation of employments. Now, you normally see this taken by HMRC aggregating employments, where employments are artificially split for NI purposes. Now, this particular one was completely the opposite. It was the individual asking for the employments to be aggregated. This was primarily because if you looked at his two employments separately, he didn't have enough contribution history to qualify for benefits. Now, this was a chap that worked initially for one ambulance agency, where they were providing ambulances for emergencies, as well as patient transport services for non-emergencies. Now, in 2013, the patient transport services contract was awarded to an independent private company, NSL. Now, the old agency and the new one, NSL, operated completely independently. Yeah, they still had contracts. The old one had the emergency contract, and then NSL had the patient transport services. Now, the two organisations operated from separate premises, vehicles and equipment. There was no board members in common between them. They did not provide services to each other, so they were quite independent of each other. Now, Martin Long had been a driver for the old agency, providing both emergency and non-emergency services. Now, when the non-emergency service contract went to the new organisation, he was then employed by both companies. And he could work for both employers on the same day. He could have an emergency contract where he drove a patient to the hospital, and then later on that day, when that patient's being discharged, he might have had a non-emergency contract driving them back. So the trip to the hospital was with the original agency, and the trip back was with the new one. Now, in 2016, due to bad health, he worked reduced hours, and he tried to claim employment and support allowance. But the Department of Work and Pensions rejected the claim as he had not paid enough NICs during 13-14 and 14-15. Mr. Long argued that actually he had one job, and the two jobs should be aggregated, so therefore he had an NI record. HMRC disagreed. They said, no, they're completely separate. And you're doing two separate jobs. So therefore your contributions paid are correct, and they're not sufficient to get the allowance. Now, this went up to the first tier, and the first tier said that for earnings to be aggregated, the two organisations must have carried on business in aggregation with each other. Now, these two companies, they were completely separate. The old one was an NHS trust, and the new one, NSL, was a private company. So very, very separate. It didn't matter who paid the two companies, that was irrelevant. The two companies operated completely independent from each other. As such, they were two different employments, and unfortunately, the taxpayer did not have enough contribution history to justify the benefits that he was seeking. So the appeal was dismissed. Now, the next one we're going to look at is an innocent mistake by a firm of accountants, which thankfully didn't cost the taxpayer. Now, this was a case called Fashion on the Block Limited. Now, the company was a fashion technology startup company, and as such, it wanted to raise funds via the SEIS scheme, so issuing shares, etc. Now, they applied for assurance, advance assurance from HMRC, and all their correspondence was headed up application for SEIS. It's very obviously an SEIS application rather than EIS. Now, HMRC granted the advance assurance and explained that a compliance statement must be submitted once the shares had been issued. Now, the company's advisors mistakenly submitted Form EIS1 rather than SEIS1. Now, the conditions of the two schemes are pretty much the same. So it's a mistake that you could argue is easily made. But the covering letter stated, please find enclosed an SEIS1 form. So it's very obvious what they were trying to do. Now, HMRC denied the SEIS claim because obviously the EIS form had been submitted. Now, that meant the investors were adversely affected because they got EIS relief at 30% rather than SEIS relief at 50%. And they had been promised 50%. So the company appealed. Now, the first tier looked at this and they said, well, the requirements for SEIS and EIS certificates are substantially the same. They did look at the upper tribunal decision in Ext Wind Power Limited, or HMRC, where it stated there's no provision in the legislation for the withdrawal, setting aside, replacement or revocation of Section 205 of the Income Tax Act 2007 compliance statement. But this did not consider, we'll take it far enough, where it was a form submitted in error. HMRC had taken a literal interpretation of the conditions contained in the legislation and basically said, well, there isn't an SEIS one submitted, so you can't have the relief. Literal interpretation. Now, the first tier said that the legislation should be applied purposefully. Now, other than the wrong form, mistake easily made, everything else had referred to SEIS. It was clear that this was the relief the company was chasing. Now, with no prior EIS investment, the conditions for SEIS relief were satisfied. So they're very much favouring the taxpayer. Then looked at the equitable remedy of rectification. Now, they went on to consider this equitable remedy of rectification. Now, in giving the information and declarations, the company believed it was providing what was required by the SEIS scheme. So the right forms, etc. It thought it was doing that. Now, the equitable remedy of rectification would be available to Fashion on the Block Limited, with the form provided by the company being treated as it had been rectified to reflect the information and declarations in Form SEIS1. So the appeal was allowed, and quite sensibly as well, I think, because it's just a technicality. And it would be wrong to deny the relief just because the form was wrong. So you'd think that HMRC would be a little bit more reasonable. But the case had to go to the first tier to get their refusal for SEIS overturned. Obviously, we need to be careful which forms we send in, but innocent mistakes can be made. In this case, we'll look at an SDLT case, and this concerns multiple dwellings relief, very valuable relief. Now, this chap, Mr. Simon Ogborn, bought a property on the 1st of November 17 and filed his return as though it were one residential property. He then seemed to realise that maybe he should have been claiming multiple dwellings relief because the property had an annex and a separate entrance. So he subsequently claimed multiple dwellings relief, which reduces SDLT bill by £20,000, and HMRC refunded the 20k. But then they looked at the claim in detail, this did an inquiry, and they denied the relief. Mr. Ogborn appealed. Now, the first tier looked at this and they said, well, there's separate entrances to the main house and the annex, which is almost like a bare minimum. Yeah, there must be a separate entrance to the main house and the annex to even have a shot at saying, well, there's two properties here, I want multiple dwellings relief. Multiple dwellings relief is where you look at the total price, divide it by the number of properties that you say you have, and then work out the SDLT on one of them, and then multiply that answer by the number of properties that you have. And invariably, it produces a lower number in terms of total SDLT. So they did say there's two entrances, which is a bare minimum, but the relief was denied because the annex didn't have the appropriate washing and personal hygiene facilities that you'd expect a dwelling to have. There was no bath, no shower or hand basin. There was a tap in the utility room and a sink, but that's not practical for the individual to live. So therefore, it is not a dwelling in its own right. So the appeal was dismissed. The original SDLT paid was the correct SDLT. This isn't two dwellings. So you've got to be careful with annexes. Can they stand up on their own 2 feet? Having a separate entrance is essential, but then they must also have the facilities that you would expect in a dwelling. That concludes the personal tax roundup for this month. My name is Dean Wotton. Thank you for listening.